It's 11 p.m. Everyone else is asleep. The house is quiet. That specific kind of quiet that makes every number on that credit card statement look louder than it should. You scroll to the minimum payment. You pay it. You close the app. And somewhere in the back of your head, a voice says, "At least I'm managing." You're not managing. You're bleeding. Slowly, quietly, and completely on schedule, because the bank designed it that way. I'm the wolf. I stopped following the herd a long time ago, and now I help others see the financial system for what it really is. No sugarcoating. No complicated jargon that makes you feel like a sheep without a shepherd. Just the truth, the math, and a clear path out. And today the truth is this: if you're over 50 and carrying credit card debt, you are not a random victim of bad luck. You are a specific, deliberate, carefully selected target, and I'm going to show you exactly how it works. Let's start with a number. The average American over 50 carries $8,100 in credit card debt. The average APR on that debt in 2024, according to the Federal Reserve, 21.47%. That means the average person in this room is paying roughly $1,740 every single year just in interest. Not paying down the balance, not buying anything new, just interest. Just the cost of existing inside the trap, $1,740 a year, for nothing, for air. Does that sound like a rewards program to you? Meet Robert. Robert is 54. He lives in Houston, Texas, makes $92,000 a year, has 2 kids. One just started college. He's not irresponsible. He's not reckless. He's stretched, like most people his age, and he's been using credit to manage the gaps. 3 cards, Chase Sapphire, $4,200. Or Citi Double Cash, $2,900. Capital One, $1,800 total, $8,900 in revolving debt. Average APR across all 3, 22%. Every month, Robert pays the minimum on each card. He feels like he's handling it. He's not falling behind, right? He's making the payments. Here's what Robert doesn't know. At minimum payments, it will take him over 6 years to clear that debt, and by the time he does, he'll have paid more than $3,800 in interest alone. On top of the $8,900 he already owed. He will pay for the same purchases twice. But here's the part that should genuinely make your blood pressure move. Robert collects miles. He chose these cards specifically for the rewards, points for flights, points for hotels. He feels like he's winning the system. His rewards last year, approximately $180 in redeemable points. His interest payments last year, $1,958. But that's not a rewards program. That's a ransom note with a nicer font. So why is Robert in this situation? Why is the 50-plus demographic the banking industry's favorite hunting ground? 3 reasons, and none of them are accidental. First, your credit score. You've spent decades building it, you've been responsible, you've paid your bills, and your reward for that responsibility is a higher credit limit, more card offers in the mail, and more rope to hang yourself with. The bank doesn't see your 720 score as a sign that you're disciplined. They see it as proof that you'll keep paying, even when it hurts. Ask yourself this: have you gotten more credit card offers in the last 5 years than you did in your 30s? Why do you think that is? Second, your life stage. At 50, the expenses don't slow down. They accelerate. College tuition. Home repairs that can't wait, medical bills that insurance doesn't fully cover, a parent who needs help. These aren't luxuries. These are real pressures that real people face, and credit card companies know the exact moment they hit. They've studied it, they've modeled it, they've timed their offers around it. Third, your loyalty. The data from the Consumer Financial Protection Bureau is clear. Adults over 50 change banks and credit cards significantly less often than younger consumers. You stay, you pay the annual fee, you accept the rate increase because switching feels like a hassle. And every year you stay is another year. They don't have to earn your business. They just collect it. You were never a customer to them. You were a revenue stream with a loyalty problem they already solved. Here's the mechanics of how the trap actually works, and why the minimum payment is the most dangerous number on your statement. The minimum payment was not calculated to help you get out of debt. It was calculated by mathematicians hired specifically to figure out the lowest amount you'd accept paying while keeping you in debt for the longest possible time. That's the engineering goal. Maximum duration, maximum interest collected. Think about that for a second. The word minimum sounds responsible. It sounds like the floor, the least you can do and still be okay. It's not the floor, it's the ceiling of what benefits them. When Robert pays the minimum on his Chase Sapphire card, he's reducing his principal by maybe $40 that month. The other $122 goes straight to interest. He paid $162 and moved the needle $40. That's not debt management. That's a subscription to debt. And here's the question nobody asks out loud. If you've been paying minimums for 3 years and the balance hasn't moved much, what exactly have you been paying for? Now let's talk about what the wolf does differently, because this is where the math runs in the opposite direction. The wolf doesn't use credit as a lifeline. The wolf uses credit as a tool, and only when the cash to cover it is already sitting in the account. The wolf pays the full balance every month. Every month. No exceptions. Because the moment you carry a balance, the card stops working for you and starts working for them. The sheep uses the card to look like they have money. The wolf uses the card to capture cash back on spending that was already planned and collects the reward without paying a cent in interest. That's the difference between a tool and a trap. Same card, completely different relationship. Now, here's the number I want you to carry out of this video. Robert pays $1,958 in credit card interest every year. What if instead of sending that money to Chase, Citi, and Capital One, he sent it to a low-cost index fund? $1,958 invested annually at a 7% average annual return over 10 years, roughly $27,000. Robert is burning $27,000 in future wealth to maintain 3 cards he could restructure in the next 90 days. That's not a small number. That's a car. That's 2 years of a kid's college tuition. That's the difference between retiring at 63 and retiring at 67. Is that trade worth it? 3 moves. Right now, this week, first, map the bleeding. Pull every credit card statement, write down the balance and the APR for each one. Calculate your weighted average interest rate. Most people have never done this exercise. They know they have debt. They don't know what it's actually costing them per year. Put the real number in front of your eyes. It's uncomfortable. Do it anyway. Second, pick a method and execute. You have 2 options. The avalanche. Pay minimums on everything. Throw every extra dollar at the highest APR card first. Mathematically superior? Saves the most money. The snowball. Pay minimums on everything. Attack the smallest balance first. Psychologically superior builds momentum and keeps you from quitting. One is better on paper. The best one is the one you'll actually stick to. Pick it tonight. Third, negotiate or transfer. This is the move most people skip because they don't know it works. Call your credit card company, ask for a rate reduction. According to the Consumer Financial Protection Bureau, this works in roughly 70% of cases for customers with good payment history. You don't need a reason, you just need to ask. If they say no, look at balance transfer cards with 0% introductory APR. Most offer 12 to 18 months interest-free. Transfer the balance, attack the principal during the window, then close the old card and don't look back. The system was designed to keep you quiet, keep you paying, and keep you convinced that this is just how it is. It's not how it has to be. Here's what I keep coming back to when I think about Robert. He makes $92,000 a year. He's not careless with money. He coached his kids' baseball team for 8 years. He fixed his own roof last summer. He is not the problem. The problem is a system that waited until his credit score was high enough, his life expensive enough, and his calendar full enough, and then handed him a card with a 22% APR and called it a benefit. The rules of this game were written by the people who profit when you follow them. And the first move toward winning is understanding that you were targeted, not because you're weak, but because you're valuable. You built something over 30 years, and there are institutions whose entire business model depends on extracting it from you one minimum payment at a time. You built it. You get to keep it. Drop unhooked in the comments if this landed. That's how we find each other. The ones who saw the trap and decided to step out of it.